Hey, hello, and welcome everybody to today's workshop. I think we are live, so hopefully everything's coming through here and you can hear me well. I should have everything hooked up today. I think a couple weeks ago we had a microphone that wasn't hooked up, and there's a lot that goes on to doing a live stream. You'd be surprised what goes on behind the scenes. But let me welcome everybody to today's workshop. My name is Jason Hamilton. I'm the founder of Keep It Simple Financial Planning and the founder of this group. And so, every Sunday about 2 o'clock, we're going to come on and do a workshop of some sort. Today's workshop, I really wanted to open up to see if there's any questions that anybody had around retirement. And the post got about 90 plus comments at this point. So hopefully you can understand that I will not be able to answer all these questions today. But I really like the idea of answering questions. If you guys go through the announcements, in the group. And by the way, if you're watching this, outside of the retirement coach group, you might want to just Google or go to Facebook search and search for retirement coach. And that's our Facebook group for folks that are retiring in about 10 years or less. We also have a second group called retirement planning for beginners. Okay. So if you're more on the beginner side or if you're younger, I guess my vision for that group was people that are more like 20 to 45 and then maybe 20 to 50. And then the retirement coach group is going to be from 50 to, 60 plus, right? So we'll be dealing with a little bit different issues. And for those that are watching from the retirement planning for beginners group, I'm going to be doing more of these Q&As in there. And actually, I'm trying to work on some technology to be able to get like a call-in show, a la Dave Ramsey or whatever you want to call it, Susie Orman. I'm not quite that fancy. I just do it from my home office here. But I think it's a lot of fun actually to answer some questions. And there's guidelines, that I can't go past certain points when it comes to investment advice. But I think I got some great questions today that are going to fall in line with what I can answer. And so I'd like to continue this if you folks are interested. So if you like this and you might be watching this now or later and you like the way that I approach and answer questions, leave me a comment below and let me know what your thoughts are. And, obviously if there's anything you think I can get better at, I'm happy to take your feedback there as well. So what I want to do is just try to provide, the most value that I can. And so, ideally, do my best to help you out with the understanding that I want to make it clear that everything here should be seen as, education or entertainment. I'm not trying to give anybody specific investment, tax, or financial advice. That has to be, there has to be a contract in place between you and I as a client/advisor to give specific advice, but I do want to give good quality information here. So if you're just tuning in, I appreciate you watching. And, today, like I said, we're going to be doing some Q&A. So with the amount of questions that I got on this post, I think I'm going to have questions now for a few weeks. And actually, I would love to continue answering questions. So if you see the post in the group, go ahead and just keep adding questions there. And then over time, what I'll do is just kind of go through and check them off, the ones I've answered and the ones that I haven't answered. Some of the questions need clarification, so I may need to follow up on that. And then, I want to put a question out to everyone that is watching this. What if I did go through the process of getting the technology in place to where we could do like a call-in show, right? Where you could call in and we can have a conversation, because some of these questions, it's like, I read the question and I think I understand it, but I need to ask some follow-up questions so that I can fully understand it. So having some dialogue in place would be great. So I think there's some services that we can do like a call in, and you can, call in, hop on for a second. We can talk and then, provide value to everybody watching. So if you like the idea of that, again, please let me know in the comments and I'll be happy to take that in consideration as we are progressing forward. So let's jump in before further ado. Okay. So I wanted to jump in today and just answer some questions. We got about 4 questions that I picked. My goal is to keep these sessions somewhere in the neighborhood of like 20 to 30 minutes. I don't want to make them too long because then people just won't watch the whole thing. So, I don't want to make this like a 2 or 3 hour show. I mean, I guess people do watch Dave Ramsey for 2 or 3 hours, but he's a pretty big personality. Ideally I want to make these so they're 20, 30 minutes so you can pop them on maybe on the way to work or, just if you're sitting around at home or if you're just watching on a Sunday, and you can get some information and continue to update your knowledge when it comes to getting prepared for retirement, because I see very similar questions over and over and over, but I know that most people have to hear the same thing about 9 to 15 times before we really understand it. So having repetitive answers, I think, is very helpful. So let's jump into a little bit of what we're going to talk about today. and some of our questions that we have. So I want to thank you all for posting the questions, because this is the only way I really know on how to answer those. Okay, so here's a question that I get all the time, okay? And I would say probably the majority of our clients come to us because, you know, they may be working with one of these large broker dealers. Like if you're working with like Fidelity or Vanguard or Schwab or whoever it is, these big folks, the one you think you might be saving money, right? Because you're not paying, you know, some sort of fee because everything's free, right? They got free ETF, no cost ETFs now at Fidelity. Vanguard's next to dirt cheap. But even their advisor services, and, you know, Vanguard charges about 30 basis points or 0.3% for their services. And Fidelity charges like 1 to 1.4%, right? And just to clarify, the 0.3 or the 1 to 1.4 is a percentage of whatever assets that you have with them in their managed programs, okay? So a couple challenges with that is, you know, I've heard recently, I saw a post from another advisor that they had a client that came over because they were at Vanguard and they're paying their 30 basis points. But one, you don't get the same advisor every time you call in, and this happens at all the places, right? This is at Schwab or, you know, Fidelity or Vanguard. You're kind of just getting a phone service, so you're getting a new person every single time, and so that's not great. But two, they had to wait like 3 months to be able to get in touch with an advisor. So, you know, maybe that's not always the case, but when the coronavirus happened, we had a huge market downturn. You're trying to get through to somebody, and, you know, you're paying such a low cost, which is great, but, you know, you usually get what you pay for. This is how kind of the market economy works. And if you can't get through to somebody, that's not good. The other thing is none of these places are going to advise you on any sort of tax planning. It's just outside of the scope, you know, of what they offer. So, you know, they might give you investment advice, but they're not going to give you tax guidance of any sort. They're going to say, you know, speak to your CPA or speak to your tax professional. I personally don't think that's a great way to do business as an advisor. So we consider ourselves a very tax-focused firm where we focus on taxes, because at the end of the day, you know, saving taxes is real money in your pocket. So this is a big thing to be thinking about. So, you know, back to our question here. Any ideas on how to save taxes in retirement? And then a second question was also, how much is Social Security taxed? So I'm going to take the second question first, and then we'll get back to the ideas on how to save taxes in retirement. So Social Security, the way it's taxed is based on your modified adjusted gross income, okay? So what that means is once your income gets past a certain point, then you have to pay taxes on Social Security. Alternatively, if you had no other income sources, or if your income is low enough, then you'll pay no taxes on your Social Security, okay? So you can just Google this information, but I just pulled up my little cheat sheet here that I have. And the way taxes on Social Security work is if you are single, okay, if you're a single filer, if you have income that is between $25,000 and $33,999, your MAGI all in, you're going to pay 50% of your Social Security income will be taxable, okay? So that means if your benefit was $2,000 a month, at that level, $1,000 of that $2,000 will be taxable, okay? If you're a single filer and your modified adjusted gross income is $34,000 or more, then 85% of that Social Security amount will be taxable. So for example, if your Social Security income is $1,000 per month, then $850 of that $1,000 becomes taxable income to you in that particular month. So that's how it works for single filers. For married filing joints, so that would be, you know, two spouses on the tax return, anything below $32,000, there's going to be no tax. But once you get to $32,000 to $43,999 of modified adjusted gross income, you're going to pay 50% of your Social Security benefits will be taxable. Okay, so if you have two Social Security incomes, they're both $2,000 each. Then you would pay $4,000 total of Social Security income. Then that would mean $2,000 of that $4,000 becomes taxable income to you. Okay. Once you get to $44,000 or above of income, which is not a lot of income for most people, by the way, but then your Social Security income, 85% of that income becomes taxable. So pretty low limits. These limits have not been indexed for inflation. I know that's something that's in the works right now that could be talked about, because these were set in place, I think, quite a while ago. I believe in the 80s, something like that. So most people that have other income sources besides their Social Security income, if you have a pension or if you're drawing from your 401k or your IRAs, then you will most likely be paying tax on some of your Social Security. Okay, so I want to make sure that we're clear on this, though, that it's not like you have a $2,000 Social Security and you get 50% of it taxed. That doesn't mean you lose $1,000. It just means that $1,000 of the $2,000 is taxed at whatever your tax rate is. Okay, so if your tax rate is 12%, 12% of the $1,000 will be paid to taxes. Same, and that goes up for the 85% bracket. So hopefully that helps on that. Okay, the other thing is around any ideas on how to save taxes in retirement. Okay, so this is actually a very big and broad question. Okay, but because there's a lot of ways to save taxes in retirement, and the way I look at it is kind of a death by a thousand cuts type of scenario, where when I look at a client's situation, I'm looking for multiple ways that we can save taxes in different areas, right? And we try to save, here or there, so then those add up to a good amount of savings. Another thing we do is we look at like alternative tax years and say, okay, maybe we can save, maybe we pay a little bit more taxes this year, but then the following year, then we can save more taxes, right? So some things to come, some things in place when it looks to saving taxes. So a couple ways to look at it. We can save taxes today, and then we can also save taxes in the future, right? So one of my favorite tax planning techniques is something called partial Roth conversions, right? So what does that mean? That means that for most people, once they stop working, they stop having their full earned income from their job, are going to have a decrease in income, right? That's pretty straightforward unless you're going directly to another pension. There's sometimes for folks that retire early, let's say if you retire at 62, and maybe you don't take your Social Security right away, so you have from 62 to 67 with no income at all. Well, there's going to be a huge opportunity in here to either convert some money from a pre-tax account like a 401k or IRA over to a Roth IRA at a lower tax bracket, which then will take that money and then it'll be in a Roth account, which will grow forever tax-free, and you never pay taxes again. So that you would do that generally up to a specific tax bracket. I hear a lot of people talk generally about just staying under the 12% tax bracket. I don't really think it's one way to look at it, but I've had clients, recently actually, that by going to the 24% bracket today, we are going to be able to get all of their money to their Roth accounts within 4 or 5 years. So then by the time they get to the required distribution age of 72, they're not going to have anything in any sort of pre-tax account, which means they're going to be, forever not paying any taxes in the future. So there's always going to be a specific tax bracket that makes the most sense for people. And it could be 10, 12, 22, or 24. What we have to remember is right now, the current tax brackets are set to sunset after 2025, okay? And if we get a Democratic president, those may sunset even earlier because some of the tax plan, and we're going to talk about this today, but the Biden tax plan does call for the current tax brackets to be reset, right? So, tax planning is something you want to look at every single year, but I want to make sure what I said so far made sense, okay? So partial Roth conversions is one way to help you have lower taxes in the future, but what you're going to do is you're basically going to take a distribution from your pre-tax account, like a 401k or IRA, and then you're going to move that money to a Roth IRA, okay? You're going to move all the money over. Generally, you don't want to be paying taxes out of that same account, up to a particular tax bracket that makes the most sense for you based on your income now and in the future. And then, so you will pay higher taxes in that year, but then going forward, every single year, that money will grow tax-free. And so when you need to draw it later, you will not pay taxes on that money. So the idea is that, you have a special window between when you retire and when you take Social Security as one, but then, really 72 is kind of the end of that window, that once you hit 72, you're going to have what's called a required minimum distribution that has to come out of all of your pre-tax retirement accounts, and also actually a Roth 401k. A simple way to avoid that from a Roth 401k is just to move it to a Roth IRA, but technically, if you left the money in a Roth 401k, you would have the RMD as well. So what you want to do is between retirement and then 72, or really 70 if you can delay Social Security, is take advantage of these windows with the lower tax brackets. One thing people ask a lot is, well, I'm pre-retirement. Should I switch all my contributions today from pre-tax to Roth, right? Because maybe you have a Roth 401k option. So it sounds like a good idea, but you have to remember that today, if you were to do that, that money is going to get put into a Roth 401k at your highest tax bracket, right? So think about that for a second. If you're making $120,000 today, excuse me, if you're making $120,000 today, and after retirement you're going to make zero, it doesn't make a lot of sense to put everything in at Roth if you're making $120,000. If you're making less money today, because maybe you're making a $40,000 salary, but if you're going to have a $60,000 pension that starts after retirement and your income is going to go up, then maybe it does make sense for you to put into a Roth today. So when it comes to, this general statement of saving taxes in retirement, there's a lot of a lot of variables that come into that. Pardon me, I got something in my throat here. There's a lot of variables that are going to go into your overall tax strategy for retirement. You're going to look at what taxes you're paying today and then after retirement. And then you're also going to look at what your income needs are and look at saying, hey, what if I don't need a whole lot from my account in retirement? If I get to 72, is my required distribution going to be more than I'm going to need to live off of, which means you're going to have to raise your taxes higher than you really need to cover your standard of living? This is where a tax planning technique like a partial Roth conversion might make sense for you, okay? Something to think about. Another technique to think about is purchasing what's called a QLAC, Qualified Longevity Annuity Contract. I think that's what it's called, QLAC. So basically it's an annuity that you can purchase inside of your IRA that essentially is meant for those later years in retirement. And it's an annuity that you turn on generally later down the road at like 75 or even 85. And you can put up to, I believe, $150,000 is the most you could put in there now. It used to be 120, 125. But if you put that amount of money into an annuity that is designed for you to have like a income later down in life, that does remove it from the required distributions. And I've actually done a training on this before. So if you look in the announcements, or you do a search for annuities, you will see when I talk about, I think I called it, good and bad about annuities, something like that. But you'll see a training in there where I talk more about the QLAC strategy. So that could be another way. Okay. Another way to consider saving taxes in retirement is income timing, right? So when do you claim certain income? So what that means is, when do you take a distribution, let's say from an IRA, okay? And then that also with that could be charitable deductions, right? So if you're a charitably inclined type of person, you may know now that the standard deduction has gotten quite a bit higher. It's $12,400 per person for 2020. So many people are no longer qualifying to itemize their deductions. So giving a charity, again, we should do this out of the kindness of our hearts because that's what it's meant to be. But at the end of the day, getting a deduction for that charitable contribution is a nice thing to do. But if you don't qualify for itemization beyond the $12,400 per person, well, you may not get that deduction for charity. So something you might want to think about is bunching. And let's say, giving a big charitable contribution in 1 year so that you then can qualify. And then in the following years, maybe not making as much charitable. So then you just get your normal tax deduction. That could be a way to do it. And when I mentioned about bunching as well, what that means is basically taking multiple years worth of income in 1 year so that the following year, your income is lower. So for example, if you needed $60,000 a year of income, well, you could take $120,000 out in 1 year, and which would then cover you for the following year. So then 1 year you'd have $120,000 of income. Then the following year you'd have zero, right? So this could be helpful if you are somebody who is looking at having to deal with the healthcare costs of pre-Medicare, but post-work and having to face the marketplace, right? So if you're not aware yet, probably healthcare and taxes are two of the biggest concerns that most retirees have when it comes to keeping the most money that they can. Because if you can qualify under the ACA health plans for a subsidy, okay, which means I think it's $67,000 and change for 2020 for a married couple. Let me get my little cheat sheet out here. So if you're below $67,000 and change, let's get the cheat sheet. I don't have that actually with me. Shoot. Okay. Well, I don't have that with me. Maybe I do. Oh, yes, I do. Okay. So California is a little different, but most states are going to follow follow this this plan. Okay, so actually I only have 2019, but I think it's pretty close. So for to qualify for a subsidy for ACA, so what does this mean, right? If you were to go to healthcare.gov and sign up for like a silver, Obamacare plan or ACA plan, and you make above the subsidy limits, okay? So for single people in 2020, it's about 49,000 and change, and for married couples in 2020, it's about 67,000 and change. So if you're above those numbers, you're gonna have to pay the full cost, okay? So that could be anywhere from $600 to over $1,200 per month per person, right? So I've seen clients that have healthcare costs up to in the $30,000 per year before they got on Medicare, because they have to have a very high level health plan because they have some health issues. The more average cost is somewhere between $800 to $1,200 per person. So that can be a very shocking and large expense for people that are wanting to retire before 65. It may look like the rest of the numbers work, but then when you look at the cost of healthcare and you want to add an additional $10,000 to $20,000 per year to cover you before 65, this can be a mind-blowing experience and completely full sticker shock, right? For people that thought they can retire a little bit early. So the way to counteract that is to get your income below certain levels, okay? So for a married couple, you want to be below about the 67,000 range. I think it's 67,640. Excuse me on not having that ready for you, but it's right around that range. And for single people, it's around 49,000 and change. So that's called 400% of the federal poverty level of income, okay? So if you're below 400% of the federal poverty level of income, you can get some sort of subsidy. The lower amount you are down, the more subsidy you're going to get. But there is a bottom that you don't want to be at, and for most states it's around $22,000. But if you go below that, then you're going to end up on Medicaid, right? So you don't generally want to end up on Medicaid because you don't have as many options. You want to stay somewhere between those amounts to where you are having some income so you can get an ACA plan, but maybe you can get a subsidy. I've seen clients that if they would have taken their full distribution, for example, and gone over the $67,000 mark, they would pay in a neighborhood of $1,200 to $2,000 per month in healthcare. But because of the way we manipulated their income and their distribution strategy for their retirement accounts, we're able to keep them under the $67,000 per year, which made their health care about $200 per month. Actually, I've seen even less. I've seen people pay zero, by the way. So when it comes to saving taxes in retirement, it's not like just a general step-by-step 1, 2, 3 strategy I can give you. There's so many angles to approach this at, and this is where I find a quality financial advisor, definitely a certified financial planner, but somebody that can actually give tax guidance can be so valuable for you that honestly the cost ends up making up for itself in multiples over. And we've helped clients with that many, many times. So when you're dealing with like these large, kind of broker dealers, the Vanguards and Fidelities of the world, you might think you're saving money and you might getting something for free. But if you're not getting tax guidance on your retirement situation, you can definitely be losing out, not only in the short term, but also on the long term, especially when it comes to things like planning for partial Roth conversions, which can then get a big chunk of your money into a Roth IRA account, which, as hopefully has no RMDs at 72, and there will be no taxes owed ever again once you get the money in there. So that can be a really beautiful strategy for folks that are looking to save taxes in retirement. So hopefully what I explained there makes sense and was not overwhelming. But if you want to talk further about that, I'm happy to chat with you, okay? So I'm going to move on to the next question here. All right, so, okay, so this is a question, we hear a lot, see a lot of things about this, quite regularly here. So here many oppose annuities. What if any percentage high and low of retirement 500,000 portfolio would you suggest to be an annuity? So here's the question. This person has a 500,000 portfolio. They're recommending, what percentage wise would you consider to be in annuities? So both husband and wife are at full retirement age. Any cautions to be considered of with annuities? Okay. So annuities in general have gotten a pretty bad rap, and it's very deserved, by the way. Okay. The challenge is in the annuity space, there's not a fiduciary requirement. Okay. If you never heard of fiduciary, that is a big famous F word that we really like around here, because if somebody is a fiduciary, then they have a legal obligation to do what's in your best interest before their own. Okay. The annuity space is really a sales-based space, and it falls under a different category called suitability. Okay. So when you are dealing with somebody who sells annuities, they really will have to make sure that a recommendation is suitable for you. It doesn't have to be a fiduciary recommendation. Okay. So there's some gray lines here that if you're dealing with like a certified financial planner, the CFP board has recently enacted a fiduciary standard across the board for all CFPs. So technically, if you're dealing with a CFP that recommends an annuity, even if they get a commission, technically it's supposed to be still a recommendation that is in fiduciary capacity. The challenge now is the SEC has really been pushing something called a best interest standard. Okay. So the best interest standards passed through. There was multiple court cases trying to get it shut down, and what the result of that was that best interest standard is still in place. So the best interest standard is basically kind of a overall financial industry standard where advisors are supposed to do what's in the best interest of their clients first. The challenge there is there's a lot of loopholes. There's a lot of loopholes in this standard. And honestly, people that come from a fiduciary perspective don't really agree that it is the best interest. So just like anything, in the political world these days, it's almost like when you see the title, whatever's in the title being, what it is, you're supposed to just kind of believe that that's what it means. And usually it's the opposite. I wouldn't say it's quite the opposite because the best interest standard is higher than suitability, but it's still not a fiduciary standard. Okay. So this is where the annuity world has gotten to a lot of problems because the big challenge is like in this space, there's a high incentive for a commission. Okay. So at my firm, Keep It Simple Financial Planning, we work on a fee-only basis, right? So what that means is we get paid fees for advice or fees for investment management. And so the incentive to sell a product, because we get a higher commission, is zero because there's no products to be sold, right? So that's why I like the fiduciary standard. I like the fee-only. But, if you're going to purchase an annuity, we definitely can get an annuity for you, but we're not going to make a commission off it, right? So in this space, it gets a little bit tricky when you're trying to find somebody to really, if you just want to buy an annuity, you don't want to pay for financial advice, you don't want to have your investments managed, you only want to get the annuity, well, then generally you're going to have to deal with somebody that's on a commission basis, okay? So some things to be considerate of are, really doing your homework. If you're going to purchase an annuity, you really want to do your homework. Some annuities I think are not bad, by the way. Okay, I think annuities for a portion of your retirement portfolio can be a decent idea if you have very low risk tolerance, right? Over time, annuities have paid generally okay rates, but if you've had your money in a globally diversified portfolio, you've almost always done better over periods of time. The nice thing with annuities is it's a guaranteed income, right? So something I want you to think about, though, before you make an annuity purchase is that you have to remember that, your Social Security is already an annuity. So you already own an annuity, and you might own two annuities. If you have two Social Security streams for you and your spouse, that's two annuities you already have coming in. And let's say you have a pension, right? If you add a pension, that's another annuity. So now you have three annuities already coming in. So before you go and purchase and another annuity beyond those income sources, remember that you might already have 1, 2, or 3 annuities there. So the benefit to annuities are they basically give you like a floor, okay, a floor of income. So, if you're trying to build floors of income, annuities can be a helpful tool to do that. I'm going to pull up my iPad here and try to do a visual example. Hopefully this works. We'll see. When you do things live, it's always fun to see if things are going to work or if they're not going to work. Okay, let's see if this works here. Okay, I'm going to pull up my iPad. I'm going to put me in the little corner here, if I can. Let me take this off for a second and move this guy around. Okay, it's not letting me. Anyways, okay. So we're going to talk about income streams, okay? We're going to talk about floor of income or income floors. Income floors, okay? So when you're looking at retirement planning, there's kind of multiple ways to do it. There's a safety first method, which is, getting as many annuities you can in place to give like a guaranteed amount of income. So let's say, for example, your income need is, let's say, $4,000 a month. Okay. So now let's take your floor here is 0. Okay, as far as dollars of income, and we're going to go up here. Okay, and we need to get here to 4,000. Okay, so let's say you have Social Security coming in that provides part of your floor. So Social Security, and let's say that's $1,500 a month. Okay, so now between Social Security and your need, we have $2,500 that we have to fill. Okay, so now we have this gap. So let's say you have Social Security, and then let's say you have a pension, right? So maybe you have a pension that's another $1,000. Okay, so let's call this your pension. And this is $1,000 per month. Okay, and so now between the Social Security and your pension, you only have $1,500 to fill, right? Okay, so if you wanted to give yourself a very secure income and you want to get to your $4,000 without having to worry about any sort of market volatility, then this $1,500 is what you can put in some sort of income annuity. Okay, so if you wanted to do an income annuity, you could do something like that. So that would definitely be something that you can consider. So let's do some math, okay, and see what you would typically need to have invested so that you can get an income annuity. So most annuities are not paying a whole lot. You might be get an average of, like, depending on your age, right? So the older you are, the more an annuity is going to pay out, right? Because generally annuities are kind of like a pension where they die at death with you, right? So they go until death with you. But if you there are some annuities that have, the fixed index annuities where you can get part of it back, but there's also some fees involved with those. But if I do annuities, I like to keep it very clean, and generally just an income annuity is going to be a good way to go. So if we need to, have $1,500 a month, right? So that's $18,000 a year, right? Yeah, $18,000 a year. Okay. And let's say the annuity is going to pay out basically 2%, on that money. Okay. So if you want to get $18,000 a year out of an annuity that's paying 2%, then you have to have about $900,000, that you purchase this annuity with to give you $18,000 a year for life. If you can get 3%, okay, if you can get 3%, then you can do, let's see here, 18,000. I'm doing my calculator. I know you guys can't see me right now, but that's not right. 18,000. Anyways, I can't figure out the math here real quickly. But anyways, so you could put a little bit less. So if we did 18,000, let me see, that'd be 600,000. Yeah, so 600,000. Okay. So if you got 2%, you need 900,000 for 1,500 per month. At 3%, it's 600,000 for 1,500 per month. Okay, so this is why annuities, they can be a decent deal, and they may also not be a great deal. So there's some things here that you really want to be thinking about when it comes to purchasing an annuity. Because you have to lock up a big chunk of money sometimes to get that annuity, and it's like, do you really want to make sure? Do you really want to give up that portion of your income that gets locked somewhere where you can't touch it, right? A lot of annuities will also be, they're called what are called deferred, right, income annuities. So basically, you put in an X amount today, and then they say, okay, we'll give you 5% average, but you have to leave your money here for 7 years or 10 years or 12 years. So, that might sound good, but at the end of the day, you're having opportunity costs when it comes to lost potential in the market. So when it comes to percentage of annuities, you really want to be considerate of how much of your money, your liquid assets, you're going to tie up in something that will cause you maybe a 10% penalty to get it back. if you're to need that money. So general rule of thumb, somewhere between 10 to 30% of your portfolio, if you're going to do an annuity, that could be somewhere to think about. But you want to make sure that you're not going to need that money anytime soon, and that you're going to be okay parting with that and taking that out of your liquid funds, right? Personally, my preference is to have a low risk portfolio that has multitudes of different types of investments so that we can generate pretty easily 2, 3, or 4%. But you have access to the liquid base of those funds without having to tie them up for 7 to 10 years. But I think if you're going to do an annuity, that's how you probably want to think about it. There's some other annuities that, some of these fixed index are okay. Some of them are not good. Variable annuities are a whole nother category where those have high costs in them a lot of times. I've seen many annuities between 2 to 3% of internal costs. And so, yes, they have a floor where your money won't go down below that. But if the investments inside there do well, and you're paying a 2 to 3% fee every year out of those investments, that could be a big problem and a big constraint on your, what you can really end up with once that annuity matures. So there's a lot to think about here with annuities. And I would highly recommend you work with somebody who's not going to make a commission off the product, so that you at least are working with somebody that is going to work in your best interest and help you make the right selection without the food that goes on their family's table being impacted by that. Okay. All right. So hopefully that was helpful. And if there's any questions, let me know. All right. So see what I'm saying? I'm doing 4 questions. We're already at 30 minutes here. So I got 2 more questions. I'm going to try to move a little bit faster here on these. Okay. So when and how much to take out of retirement funds? I know it depends on circumstances, which is very true, but what if you don't really have to, but feel like you should just because you can? Okay, so this is a question that we get quite a bit. I have a lot of clients that are frugal folks. They're kind of like me, right? I like to save a lot of my money. I don't like to spend a lot. I drive a Hyundai. I don't need to be fancy. I like to save and live simply. And that's why I have the Keep Life Simple, Keep It Simple Financial Planning. I really think simplicity is good, and I think saving money is good. But what happens is if you've been doing these behaviors, right, when you've just been saving and scrimping for like 30 years, and now you get to retirement and your income need is so low because maybe you paid off your house, you're just not a big traveler, you're just happy with just a simple life, but you have all these retirement funds, it's like, well, it's a whole shift in mindset, right, to go from saving to spending. And this is actually a very common thing to deal with. And actually, there's a lot of psychology that goes in when I'm working with clients to help them realize that you can spend and how much you can spend, and to actually get people to take the step to take money out of these accounts, right? So the first thing to think about when it comes to this is if all your money's in a pre-tax account like a 401k or IRA, the government's going to force you to take money out of it anyways, right? At 72, remember we talked about this, you have your required minimum distribution. So no matter what, money's going to have to come out at 72. So ideally, you don't want to wait until 72 to start drawing money. If you're not going to need a whole lot of it, then you want to go back to the first question and look at tax planning and look at some techniques like partial Roth conversions and look at some techniques to get money in the places to where you won't have to be, under the government's thumb, forcing you to take out a lot more money than you need once you get to 72. Okay. The other side of it is you have to remember, folks, we only have so many good years. Okay. I've seen people's health change so quickly that in a matter of like 3 to 6 months, they went from being, could take any trip in the world, hike to any mountain they wanted to go hike, to really not being able to travel, not having the physical capabilities to do these things. And then you have other situations like COVID that are just a total nightmare and have totally limited travel, right? So if you're somebody who doesn't really need your money because you can live off whatever other income sources you have, and you don't need your retirement assets that much, I would encourage you to find ways to really enjoy your retirement funds in the way that is best suited to your values, right? Maybe you want to bless some people and you can see people really enjoy some money while you're alive. Maybe it's a child or grandchild or a church or a nonprofit organization. Or maybe it's the vacation you've always wanted to take that you just haven't taken it because you never thought you can really afford it and now you can afford it. I would really encourage you to not overspend, but to really enjoy some spending in the early years, especially in generally the first 10 years. We call those your go-go years, where you have the most energy, the most physical capability, and the most available options when it comes to enjoying your funds while you can. Because once you get into your late 70s, it's just you can't do things as you could at 62, right? So I really want you to think about it like that. So when it comes to when and how much to take out of your retirement funds, a couple things to think about. So when is based on taxes, right? I think I always start with taxes. Obviously, you want to look at things you want to do. But if you have years where you can take out a certain amount of money and stay in a lower tax bracket than you would the following year, well, let's take money out while you're at the lower tax bracket and put it aside so that we can have it before maybe the following year where we're going to go to a higher tax bracket, right? How much is going to be dependent on your situation, okay? A lot of people follow this whole 4% rule thing that was designed back in the 90s. I mean, it's okay, but I really don't like that rule at all. It's pretty much in almost every case, it's either more or less than you should spend, to be honest. For some people, 4% might be too much because they retire very early. For some people, 4% might be enough. And there's plenty of people that have ended up at the end of retirement with double what they started with because they only took out 4% and the markets did well. Okay, so I really would like you to have what's called a dynamic spending strategy. So what that means is your spending strategy might change year to year, where maybe you do develop a baseline, and maybe that baseline is 3% or 4%, whatever you need. But when you look at how the markets have done, and if your investments have done better than expected, well, then let's shave some off the top and let's put that down in our spending bucket. If our investments have done worse than expected, well, then we probably need to pull back some of our spending so that we may not even take out 4% in a particular year, right? So when it comes to managing a retirement plan and a retirement spending plan and a retirement income plan, I recommend you use a dynamic strategy that looks at all the variables, and year to year, you make your decisions for the following year, because that's how you're going to get the most out of your money. There's some research studies that have shown you can get somewhere between 14 to 17 times more spending by following a dynamic strategy versus a fixed 3 or 4% safe withdrawal rate type of strategy. So I'm a much bigger fan of maximizing your money, and that's going to take a little bit of work each year, but I definitely think it's worth it so that you can make the most out of your best years. All right. So hopefully that is helpful. All right, we're going to get to our last question, and I'm going to wrap up for today. Okay, so this one is going to cause chaos, okay? So what do I think will happen if Biden gets elected? Maybe it won't cause chaos. I don't know. All I know is we're in a political climate right now that is like insane. People are not rational when it comes to the way they're responding to a lot of these questions. I personally try to stay apolitical in this sphere here in the group. We don't allow political comments. We try to keep away from all that because it all just goes haywire every time someone says, something about voting for one candidate or another. Okay. So in the long term, I don't think it's going to matter in the long term that much what's going to happen with Biden gets elected. Could we see a definite dip in the market if he were to get elected? Possibly. Okay. That's definitely something possible. But if you were to look at the last 20 years, there's been dips and there's been increases. But generally over time, things are going to go back to kind of a steady place. One thing I am concerned about, I'm going to talk to you about this a little bit here, is the Biden tax plan, because based on the analysis, it's not looking too good. Let me see here. Where's my little screen? It's not looking too good on what there we go, on what's projected for the Biden tax plan. Okay, so I encourage you to look this up, and I encourage you to read through this on your own. Okay, don't just take my word for it. I encourage you to do your own research, but I'm going to go through here what I've been reading about it so that we can look at it together and try to understand how increasing taxes is going to impact us long term. Okay, we have kind of a unique situation where we have, the Trump side wants to lower taxes so much that we're even going to get rid of payroll taxes, which puts Social Security in jeopardy potentially. Okay, but if we go to the other side where Biden wants to raise taxes, well, now we have potentially less income for everybody and a drag on the economy, right? Potentially long term. So this is from the Tax Foundation, and this is some of the research that they found. Okay, so we're going to talk about this a little bit, and I'll talk a little bit about my opinion, right? So former Vice President Joe Biden would enact a number of policies that would raise taxes, including individual income taxes and payroll taxes on high-income individuals with income above $400,000, okay? Biden's tax plan would raise tax revenue by $3.8 trillion over the next decade on a conventional basis. When accounting for macroeconomic feedback effects, the plan would collect about $3.2 trillion over the next decade. So what this means is, because of increased taxes, there's going to be some macroeconomic effects where we're going to have lower production or lower GDP growth, which actually they're expecting to only see about $3.2 trillion collected instead of the $3.8 projected. Okay. So this group has also projected that the Biden tax plan will reduce GDP by 1.51% over the long term. Okay, so if you're an investor and if you're somebody that invests in the markets, this is not good for the long term. Okay, you do not want GDP to shrink because that means lower stock market gains, lower profits for companies, lower overall economic growth. So if you're somebody who has money in the market and you're an investor, this is not good. Even if your income is less than $400,000, so you might not be affected in this case, that is something that is very concerning when it comes to overall growth, which means that if you're following something like a 3 or 4% withdrawal rate type rule, well, your portfolio may not keep up if this is the case. So this is something you have to be very considerate about. Okay, so on a conventional basis, the Biden tax plan would lead to 7.8% less after-tax income for the top 1% of taxpayers, 1.1% lower after-tax income for the top 5%, and around 0.6% after-tax income for other income quintiles. Okay, so this basically means that they're expecting everybody's after-tax income to go down based on this tax plan, right? So this is going to affect everybody, even if you're not, at the highest levels. Okay, because first thing is they're going to repeal the TCJA components for high-income tax filers. We're going to increase Social Security payroll taxes. So currently, Social Security stops at $137,700. So after that amount, you don't pay any additional any additional payroll tax on your income. But now, if you're above $400,000, this is going to make a 12.4% tax come into play there. It's going to increase corporate taxes to 28%. This is a little more technical, but it's going to establish a corporate minimum tax on book income. So book income, all that is like when a company basically shows profits for investors, but it doesn't mean they pay tax on that money. So book income is kind of a different thing. And then double the tax rate on this GILTI. And this is basically like international income. So, the Trump tax plan has basically lowered the taxes to bring income back in. And this is going to double that rate to where, like, let's say Apple has a lot of money stored offshore in Ireland. I think that's where they were keeping it all a few years ago. Well, if the tax rates are high, well, then there's not an incentive for Apple to bring this money in. But what this tax plan wants to do is basically do an estimate of what they're expected to owe and then tax them on it anyway. So, they're going to find a way to get, some taxes here. So this is in billions. So this will be 3.8 trillion. So conventional revenue from between 2021 and 2030 would be about 3.796, so about 3.8 billion. Dynamic is what we probably actually receive. And it's expected to lower the GDP by 1.51 and basically lower the full-time equivalent jobs by $585,000, okay? So something that, for those of you that are not business owners, if you're a business owner, you realize that the less taxes you pay, the more you have to invest in your business, right? And I'm a business owner. So when I heard about the payroll tax being removed, which would give me 12.4% more money to reinvest however I decided, the first thing I think about is how can I grow my business? How can I hire people? How can I reinvest in what I'm doing to get a better return than I would just having the money sit in my bank account? That's the first thing I think about. But not if you're an employee, you may not think about it that way. But what you have to consider is that, if you're an employee and you're out someone that's trying to find a job, well, if we're reducing the full-time equivalent jobs by $585,000, this is going to impact your ability to get gainful employment, right? This is going to impact your ability to get a decent wage if you want to, let's say, retire early and potentially get a job after retirement, okay? So these are things that are going to be a strain on the economy, and it's going to slow growth. And so, my opinion is if we slow growth, that's not great, okay? A couple of other things to think about are that they want to tax long-term capital gains and qualified dividends at a 39% rate on income above $1 million. And this is a big one. Eliminate step-up in basis for capital gains, okay? So what this means is if you inherit a property, for example, from your parents, right? So let's say your parents bought this property, and we'll use California numbers because they're more fun. But if your parents bought a property for $500,000, let's say 13 years ago, and now today that property is worth $1 million, right? And if you inherited that property today, you get what called a step up in basis, to where you're going to pay zero tax on the difference between what was the basis in the property, which is $500,000 that your parents bought it for, and the $1 million you're receiving today. You get to inherit that with no taxes. what this plan wants to do is eliminate that ability, right? So not only do they want to eliminate the ability to get the step up in basis to pay no tax, they also want to get rid of the long-term capital gains rate. So instead of paying 15% on the $500,000 increase, you could pay up to 39.6% on that amount of money. So this is going to have a big impact on anybody inheriting a home or stock or whatever other property that normally gets a step up in basis after somebody dies. So this could be a really, really big negative effect and could be a lot of taxes owed if you're somebody that has inheritance that you might receive, or if you're planning to leave an inheritance to your children. Okay. There's some other things a little more technical, but caps the tax benefit of itemized deductions is 28% of value, which means that taxpayers with tax brackets tax rates higher than 28% will face limited itemized deductions. So today this is 24. The previous rate was 28. So anybody above this amount will then face limited itemized deductions. Okay. And then for business owners, this is actually a big deal. They will get rid of the QBI deduction, which is 20% reduction off incomes above $400,000. So business owners will definitely get hit with that. This can be good, and I actually think we should do this anyway, by the way, but it will expand the earned income tax credit for childless workers age 65 plus, and provides for new renewable energy tax-related credits to individuals. Earned income tax credit can be good for people that are low income. This was doubled with the TCJA, so this is now double what it was before. But I think we could do a little bit better on this for our lowest of the lowest income workers, because I do think that is something to consider. Okay. It is also going to increase the tax rate on corporations from 21 to 28%. So what does this mean? Less hiring, and less jobs. This is what it means at the end of the day. And so, like it says here, economic effect, what they're believing is that we're going to reduce the economy size by 1.51% in the long run. And so, eventually leading to 585,000 fewer jobs, right? So this is something, you really want to think about if you're considering voting for this particular tax plan, right? So I really try to keep things focused on taxes. At the end of the day, I'm a financial planner. So I'm a certified financial planner. So regardless of what happens, it's going to benefit me because there's all these changes that my clients are going to need help with. But, I really want you to think that if you want to have these increased taxes, it's not just going to affect only the rich. You're going to see this across the board. And in all honesty, I would rather have you, the person who earns the income, receive the money and decide what to do with it versus the government telling us what to do, because over time, whatever the government has generally done has usually been worse off than we make our own decisions, okay? If you want to read more about this, I just finished this book recently. It's very good, okay? It's a book by Thomas Sowell. It's called Wealth, Poverty, and Politics, okay? So it's a very good book. Hopefully you can see that. And he actually talks in there about what the welfare state has done to the poor, okay? And there's a lot of evidence in there that really shows that the welfare state has actually hurt the poor a lot more than helped the poor. I do believe that there's always going to be a bottom 10 or 15% of our population that's going to need help, right? It's just what it is. When you look at the data and the statistics, about 10 to 15% of our population is always going to need help, and I truly believe we should help them. But there is a point where if we give too much incentive to people to not work, this leads to lower productivity, right? And lower productivity means lower GDP, which means slower growth of the economy. For example, with the ACA plans, for example, let's talk about that. With the ACA plans for healthcare, if you are self-employed and you're a married couple and you make over that $7,000 mark, you go from having basically healthcare that's pretty much subsidized, might be $200 to $400 a month, to $1,400 to $1,600 a month. This is what happened to my wife and I, right? When I first started my business a few years ago, I was living off savings. I didn't have any real income. But in 1 year, we went from having basically zero income to being, this is not the first year of business, like the third year of business, but it went from having zero of income up to, over the $6,700 mark. So we went from being on what's called Medi-Cal here in California, which we had no choice to be on. I tried to get on ACA, but if your income's low, they will not let you get on it. To then going from paying basically zero to having to pay $1,400 a month, which per year, what does that equate to? 1,400, 12 times, that's $16,800, right? So when I went from making just over 67,000, I now had to make over 80,000 to have the equivalent lifestyle that I had at 67 because of the difference in the subsidy. Okay, so for a lot of people, okay, you have to understand human nature, and this is something that I have dealt quite a bit with because I work with very wealthy populations, and I work with very low-income populations in the nonprofit work I do. And human psychology is a real thing. Okay, just giving people money, like Andrew Yang wants to do a universal basic income where everybody gets $1,000 a month. I do agree that it's not enough to make a huge impact, but it is enough for some people. Like, if you talk to homeless people, a lot of them just don't want to work and they don't want to be in the system. And if they have $1,000 a month, they can get their food. They can live in a tent on the street in LA, because if you go to LA, it's tent city everywhere. And there's no real incentive for them to work. So you have to look at human nature and really look at, are we doing the right thing for the human, not only because we feel like it's the right thing just to give to people that are poor. Because at the end of the day, if people have incentive to be productive, we're going to be productive. If they have incentive to be or have to be unproductive, we're probably going to lean towards that. We're humans. We're not perfect. So all that to say is, I'm not really a big fan of the Biden tax plan. I am concerned about removing the payroll tax completely when it comes to Social Security, but the Trump administration has committed, saying that we are not going to touch Social Security. They're going to pull it from the general fund. And if the removal of those taxes can grow our top line, right? Which means there's more revenues coming in, more jobs being created, more individuals paying into the tax system because we have low unemployment and the incomes are higher. There is potential for us to continue to fund Social Security, but do it through economic growth versus from a required tax that gets put into a fund that's invested at horrible rates. So the rate of return is so low that we have to keep raising that tax amount to be able to meet the needs of this program long term. So I think both sides have some issues. I'm glad I'm not making these decisions. I'm just giving you my opinion on what it is. So hopefully you found this interesting and you liked what we did today. I appreciate everybody watching. We're almost an hour here. I'm going to wrap up. But if you want to have a chat, if you want to talk about your situation, if you want to potentially work with us and discuss, get your retirement plan in place so we can help you optimize your taxes, your investment situation, and your overall retirement game plan, I can tell you, folks, it is pretty substantial. Actually, I should say very substantial. When you get a real retirement plan put in place, it accounts for taxes, investments, distribution strategies, the proper insurance, retirement income, and making sure you're doing all the right things together, optimizing your Social Security, optimizing pensions. It can have a huge impact to your bottom line. So I would love to offer you a chance to work with us. We'll talk about your situation on a complimentary call. There's no cost to the call. It's keepitsimplefinancial.com/talk, and there you'll find my calendar to schedule a call. Like I said, no obligation to work with us. What we're going to talk about on our call is what you're doing well, what your opportunities are, and what are the things you need to do to make sure you're in good shape for this next stage. If the things that I recommend for you are outside of the scope of your capabilities, then let's talk about working together. If you want to take my recommendations and just do them on your own, then that's fine too. There's no cost, okay? So keepitsimplefinancial.com/talk, and we'll see you. Hopefully we'll see you there, or we'll see you next time. If you like this Q&A, I love this Q&A. This to me is so much fun. I spend hours and hours sometimes thinking and researching of what should I talk about, what should I do a presentation on, creating my slides and all that. That sometimes I don't even know if it's what you want to know, right? So I love these Q&As. If you like the Q&As, please leave me a comment. Let me know that you liked it, and I will do my best to address your questions long term, okay? So before we wrap up, I'm going to go through the questions you have down below, and then we're going to call it a day, all right? So, add the broadcast. Okay, so Mary asked, what about standard deductions? Does that reduce it? I'm guessing you're talking about ACA. And so when you're talking about your ACA income, standard deductions do not reduce it. Is line 7. So it is AGI. So I believe, hopefully I'm saying that right. It's not, line 7 is what's determined on your tax return, is what determines your ACA capability. So standard deductions don't quite come in place. But things like 401k contributions or IRA contributions or HSA contributions, those do come into place there. Okay. So Pat said, when FOIA changed, getting a different advisor every time, I moved my money to you after listening to seminars for many months, never regretted it. Okay, well, thank you very much, Pat. You are amazing. But yeah, this is the thing. When you're working with these kind of big advisors, you might get your you might get a new advisor every single time. And what I can tell you is when you're doing real retirement planning, there's a lot of variables that go into this. And so like if you have somebody that's just looking at your situation while you pick up the phone, there's no way they can completely understand all the different variables that are going in. There's just a lot of things when you're doing a proper retirement plan that are going to affect it, right? So it's like if you move one thing in a retirement plan, like higher spending, for example, or a different Social Security timing or claiming time, it's going to have a spider web effect where like you change one thing here and it's going to affect 5 or 6 other things, right? So a quick call into a 15-minute line, it's okay for only investments. But if you really want retirement planning that includes tax planning and everything else that goes into it, I don't really think these discount services are the way to go. You're going to miss out probably long term. So, all right. Lai asked, does a Roth withdrawal count as income? Yes, it does. So it is income in the current year. But the idea, Lai, is that you can get the money from your pre-tax account to a Roth account in a low-income year. So then forever, for the rest of your life, that money is going to grow tax-free. So then when you need to take it out, it is tax-free distributions. Not only that, with the new Secure Act that was in place as of January 1st, 2020, now inherited IRAs and 401ks that are non-spousal or meet the other exceptions have a 10-year requirement to distribute, right? So if your children inherit your $1 million IRA, for example, and they're in their 40s or 50s, and they're in their highest earning years, and they have to remove all that money out of their IRA in that amount of time, especially if we get a Joe Biden tax plan where all the income rates are going higher, you could pay over 50% of your money to taxes. It's just going to disappear. So half of your legacy could be gone in that case. So, Lai, to answer your question, yes, you will pay higher taxes today, but our tax brackets are pretty low comparatively. I think they're probably the lowest ever. So if you get your money to a Roth account today, yes, you pay a little bit of tax, but then forever they go tax-free. And when you pass that money on, if you do, yes, it has to come out in 10 years, but if it's coming out of a Roth account, it's 100% tax-free. So that's a beautiful way to pass on a legacy. So, all right, hopefully that helps. Okay, so Sean, Buff Sean is back. Oh, wow. Sean, I didn't mean to make this so big. Okay, so I saw that when withdrawing money in retirement, one should draw out in the proportion of your holding in Roth, traditional, and brokerage account. So I think you're talking about a pro rata, Sean, where you take a little bit of portion out of each one. Everybody's have a different withdrawal strategy, but generally it's going to make sense to take out of either taxable or tax deferred first, and you want to leave your Roth money to last generally. So figuring out the order, but depending on tax brackets, it could make sense to pull from each to keep you in a lower tax bracket. So this is where your tax efficient withdrawal strategy comes in. So if you do not have a tax efficient withdrawal strategy, that alone could be worth the price of admission to get a financial plan. So I'd love to help you out with that if you need some help with that. Okay. All right, so this is a good question here. If you retire in your early 50s, can you withdraw from your Roth IRA or 401k? The answer is yes. Okay, so any contributions to your Roth IRA can be taken out anytime. Okay, contributions are always removable. Earnings have a different rule. Okay, that's where the 5-year rule comes in. You might have heard of before. But contributions can be taken out anytime from a Roth IRA, so the answer is yes to that question. All right. Here's an interesting one. Lisa, what is the best day of the year to retire? I don't know, today? I mean, what do you, for example, December 31st or January 2nd, my birthday is in November, someone's best day to retire. Okay, so you know what? This actually might make sense to think about it like this. If you're going to retire, if you think about retiring December 31st, but you can push off for like another month or two, and you can fill up your Roth IRA for the following year. So let's say you wanted to retire December 31st, 2020, but you can stay for an extra month or two and now contribute to your Roth IRA or your 401k for 2021 and max that out and only have to work 2 months. You might want to consider staying. Same thing for your HSA. If you can stay a little bit longer and fill up an HSA in the next year, that might be a good way to do it. So I think that's a good question, actually. All right. Right. So how do you convert IRA to Roth while trying to keep your income below $174,000, keep Medicare payments low? That's exactly what you do. So you just keep it below that amount. You want to make sure that your MAGI, right? So it's MAGI for IRMA. It stays below that amount. So that's the key. All right. So let's see here. Is the new holiday tax deferral mandatory? I think, I don't know if it's mandatory. I know there's a lot of employers that are pushing back on it, a lot of tax professionals that are pushing back on it. Even the payroll companies are pushing back on it. So, I don't know if it's mandatory, but I would say it's optional probably, because if you want to pay, I think they're still going to take your money. But ideally, if you can keep 6.2% for the last few months, then maybe you want to do that. So good question, though. All right, good. So I'm getting some comments saying you guys like the Q&A, so maybe we'll keep this up. But other than that, folks, I'm going to wrap it up for today. I appreciate you so much. If you want to chat with me personally, book a call, keepitsimplefinancial.com/talk. And I think I'm going to keep these Q&As going. I like these a lot. They're so much more fun, interactive, and I can just hop on and chat with you. So appreciate you guys. Have a great weekend. We'll talk to you soon, okay? Bye-bye now.